Module 5. Understanding Risk. Introduction to Module 5. You are now almost ready to trade. But before you enter the market, we need to talk about something serious. Risk. Many beginners focus only on profit. They think about how much they can make. Few think about how much they can lose. This is why many new traders fail. Smart investors think about risk first. Profit comes second. Let's break this down in simple terms. Lesson 1. What is risk? Risk is the chance of losing money. Every investment has risk. There is no such thing as zero risk in the stock market. Even strong companies can fall. Even safe-looking trades can turn bad. The goal is not to avoid risk. The goal is to manage it. If you control risk, you stay in the game. Lesson 2. Risk versus reward. Every trade has two sides. How much you might gain. How much you might lose. This is called risk versus reward. For example, if you risk $50 to try to make $150, your reward is 3 times your risk. That is a 3-to-1 ratio. Good traders look for trades where the reward is bigger than the risk. But remember, even good trades can lose. That is normal. The key is keeping losses small and letting wins grow. Lesson 3. Why beginners lose money. Most beginners lose money for simple reasons. They risk too much on one trade. They trade without a plan. They chase fast moves. They refuse to accept small losses. One big loss can wipe out weeks of gains. This is why risk control matters more than being right. You do not need to win every trade. You just need to protect your capital. Lesson 4. Position size. Position size means how much money you put into one trade. If you have $1,000 in your account, should you put all of it into one stock? No. Many traders risk only a small percent of their account per trade. Some risk 1% or 2%. This way, even if a trade goes wrong, the damage is small. Small losses are easier to recover from. Large losses are not. Lesson 5. Stop-loss orders. A stop-loss is a tool that limits your loss. You choose a price where you will exit if the trade moves against you. For example, if you buy a stock at $50, you may set a stop-loss at $47. If the price drops to $47, your trade closes. This protects you from deeper loss. It also removes emotion. You decide your risk before the trade begins. That is power. Lesson 6. Diversification. Diversification means spreading your money across different investments. Instead of putting all your money into one stock, you spread it across several. If one falls, others may rise. This reduces overall risk. It does not remove risk. But it softens the impact of a single bad move. Lesson 7. Accepting losses. Losses are part of trading. Even skilled traders have losing trades. The difference is how they respond. They accept small losses quickly. They do not fight the market. They do not hope and pray. They follow their rules. Think of losses as business costs. Every business has expenses. In trading, small losses are part of the cost. The goal is simple. Keep losses small. Keep emotions calm. Stay consistent. Module 5. Summary. In this module, you learned. Risk is the chance of losing money. You must manage risk, not avoid it. Risk versus reward helps guide smart trades. Position size protects your account. Stop losses limit damage. Diversification reduces exposure. Losses are normal and must be accepted. This module may be the most important one so far. Because in trading, survival comes first. In the next module, we will begin reading stock charts. You will learn how to see trends and understand price movement in a simple way. Now you are thinking like a smart trader. And that changes everything.